Imagine boosting a pension without take-home pay shrinking by the full amount taken out. That's the quiet trick behind salary sacrifice, a completely legal arrangement used by millions of UK employees. It doesn't create free money, but it does change how money is taxed on its way into a pension. Over a working life, that difference can add up to something enormous. Salary sacrifice means agreeing with an employer to give up a slice of gross salary before it's paid, in exchange for the employer paying that same amount straight into the pension. The employment contract technically changes, which sounds bureaucratic, but for most staff it's a simple tick box during payroll enrollment. Because the money never reaches the payslip as salary, it never gets taxed as salary either. Ordinary pension contributions are usually topped up with tax relief afterwards, clawing back tax that was already paid. Salary sacrifice skips that whole process. Because the income is never taxed in the first place, it simply never counts as taxable pay. The direction is the same, less income taxed overall, but the route there is more direct and entirely automatic through payroll. Here's the part a normal pension contribution can't match. National insurance is charged on salary, but it isn't charged on money that's sacrificed away before it ever becomes salary. That saves national insurance for the employee and separately saves it for the employer too. Some employers even pass part of their own saving back into the pension, effectively adding a bonus contribution from nowhere. Picture two employees on a £35,000 salary, both increasing their pension contribution by £100 a month. One claims it back as normal tax relief, the other routes it through salary sacrifice. Because sacrifice avoids national insurance as well as income tax, the sacrifice route typically leaves noticeably more sitting in take-home pay for the exact same amount landing in the pension. Move the same comparison up to a £60,000 salary, and the gap usually widens, since higher slices of income often sit in a higher tax band. The sacrificed amount reduces income that would otherwise be taxed more heavily, and it still escapes national insurance too. None of the exact percentages are fixed forever, so current bands are always worth checking on gov.uk, but the direction stays consistent as salary rises. Because none of the sacrificed amount is skimmed by national insurance on the way in, every pound of it starts working inside the pension straight away. Assume a modest, unguaranteed growth rate applied over a long working life, and that small monthly difference compounds year after year. It's an assumed return, not a guarantee, and capital is always at risk. But the extra pounds invested early do a lot of the heavy lifting. Because the employer also stops paying national insurance on the sacrificed slice, some workplaces choose to add all or part of that saving back into the pension as an extra contribution. Others simply keep the saving for the business, which is worth checking in an employee handbook or with HR. Either way, the employee's own saving on tax and national insurance stands regardless of what the employer decides to do with theirs. None of this is without caveats. There are pitfalls around mortgages, minimum wage, and certain benefits, plus a genuine change arriving from 2029 that alters the national insurance picture on sacrificed contributions. The next part unpacks exactly what shifts, whose salary sacrifice tends to suit best, and where it can quietly cause problems. Checking the current position on gov.uk before making decisions is always sensible, since these mechanics evolve. Before the pitfalls, a quick reality check on the future. There's a widely reported plan for rules to change around 2029, potentially bringing national insurance into play on salary sacrifice for the first time. Nothing is locked in yet, so treat this as direction of travel, not a fixed fact, and always check the current position on gov.uk. The mechanic being discussed is narrow. It's not scrapping salary sacrifice, it's about whether national insurance still gets fully avoided on the sacrificed slice above a certain level for employer and employee. The income tax saving isn't the part under discussion here. That side of the mechanic looks set to carry on working the same way. Why look at it at all? Salary sacrifice has grown hugely popular, and every pound of NI it shelters is a pound the Treasury doesn't collect. Governments periodically review reliefs that cost more than expected, which is normal housekeeping rather than a sign the whole idea is being dismantled. It's simply worth knowing the ground can move. Even in the more cautious version of the future being discussed, the income tax relief and at least part of the national insurance saving are expected to remain. That means the core logic, more money reaching the pension before it's taxed, still stands. The size of the edge might shrink a little for higher earners, but the mechanic itself isn't disappearing. Now, the pitfalls, and the first is mortgages. Lenders typically work from the salary shown on payslips and P60s, so a lower headline salary from sacrificing can reduce how much they'll offer. On an illustrative case, sacrificing enough to knock a few £1,000s off salary could trim borrowing by tens of thousands of pounds using typical income multiples. Second, there's a hard flaw. Salary sacrifice can never take cash pay below the national minimum or national living wage, whichever applies. Employers running payroll software will automatically cap or block the sacrifice if it would breach that flaw, so this mostly affects lower earners or anyone sacrificing a large percentage of a modest salary. Third, a lower reported salary can quietly touch other things. Statutory maternity or sick pay, some life insurance multiples arranged through work, and certain means-tested benefit calculations can all be based on that lower figure. None of these are reasons to avoid sacrifice outright, but they're worth checking before increasing the amount sacrificed by a large jump. Put together, salary sacrifice tends to suit people with a stable salary comfortably above minimum wage, who aren't about to apply for a mortgage or remortgage, and who aren't relying on income-linked benefits or statutory pay calculations. Higher and additional rate taxpayers often see the biggest percentage boost, simply because more tax and national insurance is being avoided per pound sacrificed. On the other hand, anyone near the minimum wage floor, anyone house hunting in the next year or two, or anyone drawing benefits tied to salary might reasonably pause and check the details first. None of that rules sacrifice out permanently, it just means timing and proportion matter. Next, we'll look at how to actually work out a sensible amount to sacrifice. Setting this up usually starts with a simple question to payroll or HR. Does the scheme offer salary sacrifice? And if so, what's the process? Employees typically sign a short agreement that varies their contract, swapping a slice of salary for an employer pension contribution. It's paperwork, not negotiation. The employer handles the mechanics once it's agreed. Nothing complicated, just a form and a payslip that looks slightly different afterwards. Once it's running, a payslip is the place to confirm it's actually working. Gross pay should show the lower, sacrificed figure, while the pension section should show a larger employer contribution than before. Tax and national insurance should be calculated on that reduced figure, not the original salary. If those numbers don't match up, it's worth flagging to payroll rather than assuming it's fine. There's also a ceiling on how much can go into a pension each tax year with full tax relief, known as the annual allowance, and it can taper down for very high earners. That limit changes from time to time, so the current figure is always worth checking on gov.uk rather than relying on an old number. Salary sacrifice doesn't get around this ceiling. It just makes reaching it more efficient. Because pay, mortgages, and family circumstances shift, an annual review of the arrangement makes sense rather than setting it up once and forgetting it. A pay rise might make a higher sacrifice worthwhile, while a mortgage application on the horizon might be a reason to dial it back for a year. Payroll or a pension provider can usually adjust the percentage with a quick email. Add all of this up over a working life and the effect compounds. On an illustrative example, someone consistently sacrificing a modest slice of salary, rather than contributing after tax, could end up with a noticeably larger pot by retirement, simply from the extra national insurance saving being reinvested each month. That's an assumed growth rate, not a guaranteed outcome, and capital is always at risk in a pension. Strip away the detail and the idea is simple. A slice of salary becomes a slice of pension contribution before tax and national insurance touch it, so less is lost along the way. Take-home pay dips slightly, but what lands in the pension is larger, and it's landed there more efficiently than a normal after-tax contribution ever could. That's the entire mechanism in one sentence. None of this requires investment expertise or a big life change. Just a conversation with payroll and a periodic check that the numbers still make sense for a given income and stage of life. Used sensibly, salary sacrifice is one of the simplest ways to make everyday pay work harder for the future without touching a savings account. Small setup, ongoing benefit, worth understanding properly. That's salary sacrifice from top to bottom. how it works, what it saves, where it's heading, and where to be careful. For more clear-eyed breakdowns of pensions, tax, and everyday money mechanics, subscribe to Clear Money UK and come back for the next deep dive.